Hey, what's up? Currently back from my shower and going to read some miscellaneous things. Gonna try to finish the Damodaran on valuation chapter, but also I was checking through my email and saw that there was a new newsletter posted by Howard Marks, and so I want to take a look at what's going on here with what he's thinking. So let's see. Interesting. That's pretty cheap. How many books? How many pages is that? Is there a PDF? Yeah, I don't know. Okay. Zach Kessler. Interesting. Okay. Then the Fed abandoned the inflation is transitory and ready to turn out to be a rather fast succession of October. Easy times. Thanks for low interest rates are multifaceted and ubiquitous of feeling. Low interest rates stimulate the economy. Discounted cash flows. Okay. Okay, so 3 things. So interest rates stimulate the economy. Interest rates will decrease the opportunity cost. So that opportunity cost usually involves the idea of just having your money sitting in a bank account or maybe in a very secure, maybe not secure, but a more safe investment, a less risky investment. And third, the, I guess, more academic or theory-based finance knowledge would say that with lower interest rates, then valuations for existing assets will, I guess, existing and new assets will all increase due to the fact that any asset is valued as all of the expected cash flows it's expected to produce, all of the expected cash flows that it'll produce in the future. And so when we're discounting them back to the present at some type of interest rate, usually reflecting the risk of the asset itself. And this kind of lies with the second bullet point in the sense that there's lower opportunity cost. And so usually when trying to determine the risk of an asset, you're really trying to look at the risk-free rate or what you would get for holding a risk-free security, maybe a treasury bill, treasury bond, and then you would add some type of risk premium on top of that for the current asset that you're trying to evaluate. So this is where I was talking about the risk-free rate earlier. Okay. Interesting. Basic liquid investments. Investment. Malinvestment, to use a term popularized by Austrian economics, comes in many shapes and sizes. It might involve some expensive white elephant projects such as constructing a tunnel under the sea or a pie in the sky. Technology scheme with no serious prospect of ever returning a profit. Yeah, one could say maybe the American Roots business is maybe a malinvestment, with the idea that trying to kind of rekindle the manufacturing industry in the US, especially textile manufacturing industry, is probably not a great idea. Oh, this is pretty big. Pretty long article. It took less than a year for interesting. Wow, there's a lot of these. Yeah, maybe it might be some time to go through all of these. Collateralized loan obligations. zombie companies. So 4 was the idea of making malinvestments. So the idea of trying to make riskier investments in exchange for higher returns because you feel a kind of requirement in order to take on more risk in order to generate a decent amount of returns. Huh. $1990. You would have been 54. Right, no. You would have been 34. 44. Yeah, 44. 1990. Okay. Oops. Oh, that's it. Okay, so I might read this a little bit more and then pause this because it's getting pretty late and then switch over to Damodaran. Spend 5 more minutes. Currently 12:25. I think low interest rates causes the idea of bad loans being loaned out. Finance readily and cheaply. Enables deals to be financed readily and cheaply. Okay, so yeah, so low interest rates increase the use of leverage. Okay. Let's say you're offered a low-rated loan yielding 6%. No way, you say. I never buy security that risky at such a low yield. But what if you're told you can borrow the money to buy it at 4%? Right, okay, what does he mean by that? But what if you're told you can borrow the money to buy it at 4%? Oh, that's a different story. I'll take all I can get. But it must be noted that cheap leverage doesn't make investments better. It merely amplifies the result. Okay, so I guess maybe it's the idea of you're using someone else's money and there's a lower yield. I'm not too sure. In times of low interest rates, absolute prospective returns are low and leverage is cheap. Why not use a lot of leverage to increase expected returns? At times of low interest rates, absolute prospective returns are low and leverage is cheap. Why not use a lot of leverage to increase expected returns? Okay. Leverage returns from company ownership and private credit, which primarily provides debt capital to private equity deals. These trends complemented each other and led to a significant upswing in levered investing. In the last decade, some companies acquired by private equity funds for sale. Just coverage ratios. I think that's the percentage of interest expense compared to net income. So the ratio of interest expense compared to net income. Interest coverage ratio. Okay, so maybe swap the two. So how much in earnings are you earning? How much in profit are you earning in excess of the interest expense for your loans? So, okay, just to recap, I think the 5 big takeaways so far in an era of easy money in this memo is that one, low interest rates promotes economic development. Two, they lower the opportunity cost for other investments. 3, from a theoretical standpoint, the present value of expected cash flows or future cash flows are higher than higher interest rate environments. So, another way of saying this is low interest equals higher values for future cash flows, higher present values for future cash flows. High interest rates equals lower present values for future cash flows. So, fourth, I think the era of easy money ended up creating the idea, or has kind of made some people to believe that in order to chase greater returns, they have to take on riskier investments. And that kind of led to this spiral, or what's the word that Ray Dalio used? A self-fulfilling cycle, taking on greater risk and chasing higher returns. Then you take on higher risk, even more risk to take on even higher returns. Maybe it's a self-fulfilling cycle. I know that's how you describe lending and the debt cycle. So there's that. And then number 5, the financing of, maybe this was also 4 and 5, the financing and deal making was really cheap. And then I think that can be tied into point number 5, is when a lot of companies will choose to lever up in times of low interest rates because it is a relatively cheap way to raise capital and raise money. But when maybe interest rates rise, and let's say that a company decides to issue floating rates debts or corporate bonds, corporate notes, then when interest rates rise and this company has decided to lever up a lot, then they might face some difficulty and have some problems paying back their investments. So I wonder if Cigna oh, okay, large privately owned property company. Yeah. So finish reading a few sections in the Howard's memo. Some takeaways. Rates. So one. Low interest promotes economic development. Decrease opportunity cost for risk investments. 3. Number 3, so lower interest rates. What was the third one again? Oh, it's 4. Alright, let me see if... Okay. So... I think Allison's calling. I'm just gonna hurry up and write this down real quick. So 3. Oh man, did I delete it? Okay. Oh, right. Interest rates, left, asset prices. So this is for he's for interest rate. Courage, risk taking. Yeah. Low interest rates increase financing. So low interest use of leverage. Okay, so I think that's good for now on this. I need to go brush my teeth real quick and then come back on the Damodaran stuff. Okay, I'm probably gonna head out for right now, actually. I'm gonna call Allison, and then I'll do the reading on my own, or maybe tomorrow. So, yeah, I'm gonna maybe write down what I want to do tomorrow, later tonight. It's kind of late, though. I should probably get to sleep soon. I'm not super tired. I shall see, though. Instead of waiting until the last minute to stream, because I spent the majority of my day watching the bear. I believe I woke up at 7:45, stayed in bed from 7:45 all the way until 3:30, 3:45. So what is that? Damn, 8 hours. Yeah, I was in bed for 8 hours watching that shit. Alright, yeah, I'll see you for